Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And here we are. This is the Investor Coaching Show, and I am Paul Winkler. And he is Evan. Hi, I'm Evan Barnum. No, I am not him. Paul Winkler, talking world of money and investing. Okay, so let's hit a basic thing here. And then, okay, so you're going to get information about investing because you've heard that, investing is a good idea.
Uh-huh.
Don't spend everything you got right now. You ought to invest.
Okay.
And my wife just reminded me of something my wife sent me yesterday. It was this guy saying if you put $100 a month
right
in a diversified mutual fund, that you will have 40 years, you will have 1.7 million or something. I forgot what it was, something like that. And I don't remember. It was something like that. It was
probably.
like $1.7 million. Well, it depends. It's highly dependent
on
on
the return assumption.
Yeah, I mean, you better.
And you didn't panic and so forth.
Yeah, in fact,
But 40 years, that's probably only that's probably a 10%
It was 12%.
return. Was it 12? Okay.
12% return was what the estimation was. And I said, oh boy. And she goes, yeah, I knew you wouldn't like that. And I said, no, I don't like it. And the reason I don't like it was because the person was not considering inflation, number one. Secondarily, I know what the person typically recommends as far as an asset mix, and it's not good. They're usually recommending like growth in income, aggressive growth, and all of that kind of stuff, which is, what you're doing is buying companies that have grown in the past. Historic rate of return, forget about inflation, for large growth companies is more in the neighborhood of about 8% to 9%. Now, why would you get 12%? Well, the reason you get 12 is because you found funds that had a 10-year track record that exceeded the benchmark or the area of the market.
For that period of time.
And then you assume that they're going to continue to exceed the benchmark by 3 to 4%. That's pretty highly unlikely. Seeing as past performance is no guarantee of future performance, as they say in the prospectus. But, so what happens is that you look at, well, what if you diversify more? You're going to have large and small and value and all of those types of asset categories. It's going to be not just in those growth companies, but even still, your expected rate of return for that long period of time, maybe no more than 7 to 8% above inflation, which is a heck of a lot better than CDs at 0.4.
Sure.
But, if you look at that and you go, well, how much money would you have? Well, the answer over that period of time would have been 1/3 of the amount of money that was being projected in that thing telling you how much you should save into a mutual fund. And I said to my wife back, I said, well, imagine living on 1/3 of your income. How happy would you be?
Right.
Not very happy. You'd be a little bit upset that you're living on 1/3, and that's a problem. So hence what happens is sometimes when people throw out numbers like that to try to sell people on the idea of investing, sometimes they over project the returns and expectations are huge. When we talk about expectations, I tell people that expect market returns, for example. That would be a better thing to do. Expect market returns. Now, don't expect 3 to 4% above market returns like what was happening in that particular presentation. So, investing in mutual funds. So you go, okay, it's a good idea to invest in mutual funds. Why? Because what are mutual funds? Well, it's commingled investment vehicles, as we often call them. And the idea being that we're putting everybody's money into a big pot. And instead of owning one share of this company, a half a share of this company, a quarter of a share of this company, and so on and so forth, I can buy in round lots. I can have lower cost 100 share units and things like that, which is not as big of a deal as it used to be, but it's still a pretty big deal to make sure that you buy more in bulk because you can do trading in blocks and things like that. Now, let's say that you do that. Now you own a fund and you own maybe 1/1000th of a share of this company and so on and so forth, and you're really, really diversified. mutual fund allows you to get a level of diversification that you can't get. It wouldn't be practical to even try to pull it off on your own, especially, if if you're a 50 to 100 millionaire, and, $50 million.
Of investable assets.
Yeah, of investable assets, yeah. And then you're looking at maybe you could pull it off, but you'd be losing on a lot of things. Like if you're using more institutional types of investments, you might be losing securities lending revenue, you might be losing the trading acumen that an institutional manager would have, where they're trading based on momentum and to keep costs down and things like that, or profitability factors or other factors, and you lose that. But in essence, the idea behind a mutual fund gives people access. So people, okay, mutual funds. People also hear about ETFs. And they say that's a good idea. And maybe in some asset classes that is a decent idea. Well, the Wall Street Journal had an article about this.
Okay.
How to invest in mutual funds.
Oh.
Was the title of the article. So, so reaching your financial goals is easy if you follow these key steps. Well, we all want easy.
Absolutely.
I mean, that would be nice.
Eat less, move more.
Yeah, exactly. So what they did is they said investing in stocks and bonds, one of the best ways to build wealth over the long term. And I would agree. If you look historically at stock markets, you get to own companies. Most successful people own companies. Just name the most successful people and where they own companies. Whether it be, Elon Musk or, Bill Gates or, Warren Buffett or, whatever. You have people that are successful, they own companies. So you look at, stocks and say, okay, so, I want to do that, want to diversify. And, how do you do that? And in this article, they're talking about owning mutual funds. And then bonds, typically what you're looking for is a part of your portfolio there where the companies are borrowing money. So they pay interest. And because, let's say a company goes totally bust, just totally bust, and all of a sudden everything has to be liquidated, their buildings have to be liquidated, their inventories have to be liquidated, whatever, the first people to be paid back are the bondholders. So you'll typically hear about bonds being safer than stocks for that particular reason, because the last people to be paid are the stockholders, if there's anything left. So hence that's why you diversify, because you could have a situation where your company goes bust, and if that's the only company you own in your portfolio, good luck. So they say, set an investing goal. So set a goal, which is a good idea. Is how long?
Totally.
How long? Like, what would be typical goals, Evan?
Typical goals, if you're saving for college and your child is, say, 10, okay, you got an 8-year horizon. Retirement, depending on your age, that could be anywhere from 10 to 40 years down the road.
Sure. So it's going to be your time horizon is going to be one of them.
Yep.
How much, how important is that time horizon? Is it a goal that's 7 years away and you've got no flexibility in that? I've got to have this money back in 7 years.
Yeah.
Well, you're not going to be as flexible in your investing strategy. You're not going to be able to take as much risk as in a market risk, because you got to make sure that money's there. You can't be 7 years down the road and then there's a market downturn and you need all that money at that point in time. You got to be very conscious of that. And then you got to say, so first thing is set your goals. Then you got to decide an account type. And there are lots of different account types out there. Like, for instance, you've got 401ks. You've got
IRAs, 403bs, Roth IRAs, non-qualified accounts.
Yeah, you've got, maybe a 529 plan for college education.
Education savings account.
ESAs.
Health savings account.
Health savings accounts. There you go. So you might have a different type of account that, depending on what you're investing for. Standard brokerage account or a regular investment account, non-qualified account, as you often hear us talk about it. Whereas I want to be restricted on how much money I can put away. I can put away as much money as I want to. Nobody's going to tell me that I can't do that. The only thing that's going to tell me I can't do this is I don't have the money. Then you got the negative of it. You got to pay taxes on interest, and you might have capital gains rates. Taxes are lower, so you're only paying taxes at capital gains rates, which the highest rate for capital gains purposes is 20. And then you might have a little excise tax on top of that. But, instead, that's a lot better than 37. And plus state income taxes if you're in a state that has an income tax. So, we look at that and we go, okay, well, and then you don't have to pay taxes unless the stock is sold at a gain. You might have to pay some taxes on the dividends. You might have qualified dividends versus non-qualified dividends. And Evan can probably do a dissertation on that. What makes a qualified dividend versus non-qualified dividend.
We won't put you through that torture, though,
I'll
this
be sleeping.
afternoon.
Yeah, I'll be sleeping at the time he gets done. So the different types of accounts. And then, then you say Roth IRAs, and you'll have limited amounts of money that you can put in. You'll have limitations. Then you can pick your investment strategy. And, one of the things they say is look at the management fees. Well, I agree. Management fees are important, but too often it's like the only thing that matters to some financial people in the press when they're talking about investing.
Yeah.
Choose your mutual funds and make sure your management fees are this. And, they used a fee of 0.6, which tells me right off the bat that you're looking at mainly investing in bigger companies because bigger companies are less expensive to manage. So that you're looking at a problem right there right away. I did a thing where I actually walked through, what if you invested in the highest cost mutual funds? Remember when I did that, Evan?
No, I don't actually.
Okay, so I did a funny thing. If you don't remember it, then some other people are listening don't remember it.
Then.
Yeah, okay. So what I did is I took the lowest cost mutual funds out there. It was like a couple of, the really, really popular mutual funds. And then I said, what if I just invested in the 3 highest cost? I mean, I combed the entire Morningstar database for the highest cost small value mutual funds. Period. End of sentence.
Okay.
And then what I did is I showed the difference in accumulation, and it was comical. I don't remember what it was. It was 3 or 6 times as much money you would have had.
So your low cost fund was probably large.
No, small value.
Oh, you were still in the same asset class.
Yes. I'm sorry. Yes, it was large. Yes, I'm sorry.
Okay,
yes.
There you go.
So I did the lowest cost funds, the most popular funds.
Right, yeah.
Yes, that's what I did.
Yeah.
And then I did it against the highest cost funds, and it was just kind of a joke that I was doing. So then they say, okay, so, you got these fund companies. Now, next thing you got to do is research your fund companies. You want fund companies that you don't have a lot of lawsuits against, which I think is a good idea.
Yeah.
You don't want to be investing with in fund companies that their name's in the media every, couple of weeks for the wrong reasons. So it's probably not a bad idea to make sure that you don't have lots of lawsuits. And then they said, they had fund companies and they had their favorites, and they said a cult favorite. And I'm really big on cults. Yeah, right. No, I'm not. Vanguard was one of them, and Fidelity was another one. American Funds was another one. I picked on American Funds a few weeks ago, so I won't pick on them again. I took all of the funds, the mutual funds in American Funds. I took their target date fund.
Oh, yeah.
And I said, what if you invested in every one of those funds that are in the target date fund?
Right.
And it was like they all own the same stocks. It was just ridiculous. Yeah. It was so goofy.
I think 9 was my record in the past for
it was even higher than that.
Analyzing a portfolio.
It was even higher than that.
Was it really?
Oh, it was even higher than that. It was more like 15.
Oh, wow.
Yeah, it was terrible. Where you had 15 different mutual funds owned Microsoft. I mean, it was that bad. It was just stupid, and this is a fund that they put together.
Right.
I didn't cherry pick
They
them.
should know. The investor may not, but they should sure know.
Yes, you would think. So then what I did is I said, okay, well, they got this cult following, blah, blah, blah. And then I said, oh, wait a minute. It says, here are some of the buy side from Wall Street Journal's favorite Vanguard mutual funds. And it's a hyperlink. So, I like hyperlinks. So I hit the hyperlink to see what the article led to. And it did. It led to another article, Best Vanguard Funds.
There you go.
And then it says Vanguard, it says very few brands manage to be the biggest players in the industry. So we're talking about the big fund company. And then what they did is they listed out their 5 favorite mutual funds.
Okay.
So all you have to do to be a successful investor is just do this. Buy these 5 funds, right? So I ran that through Morningstar. And what I found was that they had 4 funds that were stock funds, was a bond fund. One was a bond fund. So I'm just going to ignore the bond fund, because we're looking at stocks and what we're looking at investing in is getting a good way to diversify our investment portfolio, so to speak.
Okay.
And here's what it looked like. So if you do what's called an overlap analysis of this, you bought those 5 funds, 3 of those 4 funds there, because 4 of them were stock funds. 3 of those 4 stock funds owned Microsoft. It was the largest holding. The second largest holding was Apple. 2 of them held it. United Health Group, 3 of them owned it. Let's see, Amazon, 2 of them held it. Alphabet, Google, owned 2 of them. Procter & Gamble, 3 of the mutual funds owned it. McDonald's, 3 of the funds owned it. Honeywell International, 3 of the funds owned it. Interestingly, 2 of the U.S. stock funds plus the international stock fund. Isn't that funny? Isn't that funny? Those 2 of them are U.S. stock funds, and they held that. Visa was the next one. NVIDIA was the next one. Texas Instruments was the next one. Need I go on? So it went on and on and on, overlap in these funds. Now, anybody want to venture kind of an opinion on, as far as the companies that I named, were they all companies that were familiar to you? Yeah, Leviticus nodding yes.
Absolutely.
Absolutely. So what are you doing? You're all investing in big, familiar companies, which smacks of something called familiarity bias. We like investing in familiar stocks. So the most popular mutual funds and the ones that they liked the most are all investing in the same stuff. And when things go wrong, which they can, we've talked about it many times, you can go 18, 20 years, no returns. No returns. 0 returns. Imagine like you're Evan, and he's talking about 7 years this goal is away.
Right.
Well, now you got to wait another 13 just to get up to the point where you have no return, where you're not in the negative.
And your child will be 32 when they go to college.
Go to college, yeah, that's fine, isn't it? I mean, if you have like great attachment to your child,
there you go.
And maybe, you like having them around, you want them around forever, living in your basement, it's not a bad idea.
Yep, totally.
I mean, could get a little bit old.
Yes.
But, you better get used to it. So hence, this whole article on how to buy mutual funds is nothing but an advertisement. You wouldn't look at it as an advertisement.
Right.
You would be reading this for information purposes. And hence, it is the reason I have such a problem with so much of the writing in the media on investing.
Well, and it's a reinforcing loop. People talk about DC being an echo chamber. Well, boy, the investment industry is the ultimate echo chamber. And, you're talking about familiarity bias. But what do you talk about with your friends if you choose to talk about investing? Or in this case, I think I was a hypothetical new investor that had some discretionary dollars to do.
Right.
You hear your friends talking about Apple, talking about Microsoft, Google, Tesla, NVIDIA.
Or those fund companies, because that's what they've got at their work 401k.
And so now herding bias kicks in. I want to be part of the cool crowd. I don't want to be the guy that says, get rid of the booze at the party,
Right.
And so all of those biases work against the investor. Which
is interesting because you think about herding bias. Why is it that we end up doing the same thing and then we all complain at the same, not we, but the investors. You think about the misery that people felt, so much so that even Barack Obama talked about the dead decade. That people had gone for an entire 10-year period with no return. And, when you get that into presidential politics, they don't talk about something that nobody's talking about.
Right.
They're talking
it's top
about
of mind awareness.
Yeah, it's what everybody's talking about. And that's exactly what was going on, where people were, and they just thought, well, everybody's going through the same thing. And misery likes company, and it feels okay. And that is part of our psychological bias because we all want a sense of belonging as humans. Now, we may get that sense of belonging, but wouldn't it be nice not to be the person that doesn't belong in that group of people that are called failed investors? Yeah. To me, that seems like a good idea. But I don't know. Maybe it's just me. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can Get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. All right, you said something about that last segment. So
Yeah,
I'm letting
you were talking about the large stock holdings that were common in those popular funds, and we're talking about familiarity and so forth.
Mhm.
And we do an exercise in the American Dream Experience, that 2-day transformational workshop around money and investing and purpose and so forth. And we have an exercise that we do on the second day called Abject Absurdity,
Mhm.
and we go through I don't know what you call it, just a role play to really drive home how crazy stock picking is and how absurd.
Mm-hmm.
And so, the inherent claim in picking a stock is, well, that's the best stock. Otherwise, I would have picked a different one. Now, you may not think that when you're choosing it. You think it's familiar, I know it, and so forth. But if we look at, I'm going to use Apple, Microsoft, Google, and Amazon.
Clearly winners in the marketplace.
Growth companies.
Well-known companies. They have clearly been winners, so they must be great investments.
That's correct. Well, over the last 5 years.
Dominating the index portfolios, as I've been talking about.
Yes, a huge percentage.
Yes.
Well, in the 5-year performance, Apple was beat by 1,120 companies in terms of performance in the last 5 years.
What?
1,120.
Wow.
Microsoft was beat by 1,239 companies.
Oh, that's amazing.
Google, 2,663. Amazon, 3,420.
Yeah.
And so
what? You got to say that last one again. 3,400?
Amazon was ranked 3,420. So it was actually beat by 3,419 stocks over the last 5 years.
That's amazing.
And so and then I'm going to cover the 3-year data.
I think it's sick that you guys actually
really
went and looked at that data.
Yeah.
You are even more bored than I am. Okay.
The last 3-year performance, Apple was beat by 2,390. Microsoft was beat by 2,994 stocks, had a better return than Microsoft over the 3 years. Google was beat by 3,992. Amazon, this blew my mind, was beat by 7,955 stocks. And so
that is mind-blowing.
There's people, like the fund or even an individual investor out there that's doing it on their own, says, well, I bought Apple and so forth. And, well, it's done well for me. It's, I don't want to pay the taxes.
Right.
And yet 2,400 stocks almost did better than that over the last 3 years. What did you maybe miss out on not paying the taxes and continuing to pick those stocks? Because stock picking isn't just at the moment of choice. Every day that you hold it, you're stock picking. I'm using that as my choice versus selling it and buying something else.
You are betting that company is going to do better than other alternatives that might be out there.
Yeah. And so, most people don't think about investing that way. Like, well, I'm not picking stocks. I bought Apple 5 years ago.
Right.
I bought Amazon 10 years ago. It's done really great. No argument for me whatsoever.
And it's not that you shouldn't hold those companies in a portfolio.
Take the win, but you were beat by almost 8,000 stocks. Maybe diversify and, go on a more academic track. It's really interesting how, well, you were talking about in a previous segment that growth stocks don't do, they return, say, 8 or 9% long term. Why? Because they're safer. They've grown. They've got huge capital. They have strong profitability. Well, going forward, that means their return is not going to be as high as a riskier company, whether it's a startup or not.
Yeah, well, and what people don't realize, they think about, I want to invest in this company. I think it's going to really do great. And then I turn around and go, do you think that they want to pay more to use your money than alternatives?
Right.
And it doesn't make any sense. Well, no, that doesn't make any sense. Well, that's exactly what you're expecting when you expect higher returns, that they are going to pay more to use your money than other people, the current owners. Because you think about it, when you sell it, you're buying it from another owner too. That's another part of it that just gets people get mixed up. And, when I buy a stock, I'm not giving my money directly to that company. So, in essence, the only time that it happens is an IPO, when it's first initial public offering is what it stands for, when it was initially put out there. But in essence, it's just an easy way to get you to understand it, that they're going to pay more to use your money, because what do they have to give up to actually get use of your money, the earnings of that company? Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.